But this has been a pretty, I would say, active week when it comes to either the market or what's happening around. Especially if you're in Bay Area, you cannot help but get caught into the whirlwind of these activities around the second biggest bank blowing up in the US history. So I do want to talk about that. Lot of, I think, hundreds of companies in Bay Area will be impacted by it. And so which is a Silicon Valley bank. That bank just blew up on Friday. And then also want to go back and talk about the seemingly zero risk option trade. And this is the one which is our takeaway from a previous session, wherein I mentioned I will review. There was one trade, which sometimes a trade that seems to be as a zero risk. It means we really don't know where the risk is. We haven't really done our analysis. So like I mentioned, I had covered it in some of one earlier session. So I was able to figure that out, which session was it, and was able to dig out those details. So I do want to talk about that as well. But before that, before I forget, one housekeeping announcement. Today's session is going to be a smaller session. It's going to be only for 1 hour. We were trying to figure out logistics to drop my kid for her competition. Nothing worked out. So by 8 o'clock in the morning, I decided, okay, guys, then it's going to be me. And then I have to leave home by between 11 and 11:15. So hopefully I want to be done by 11, get in the car and drive her to competition. I don't want to be the reason that she reaches late. Okay. So this is going to be a 1 hour session only today. Today focus is mostly on learning from the mistakes. There are two. So Bob asked, what is she competing in? She is in, she just reached the regionals, made it to the regionals of US Bio Olympiad, so USABO, and that's what she's competing in. And for all the reasons, she likes biology, the subject that me and my wife, we both hated throughout our school. So, but she loves it, and she has been, very interested in it. And I'm like, go ahead. So few students are made to the regionals. She's one of them from her school, and that regional bio Olympiad is today. So that's why it's going to be a shorter session. I have to leave by 11 o'clock. So we're going to have 1 hour session instead of regular 2 hours. Maybe from next week, we'll get back to our regular sessions. All right. So yeah, I do want to talk about these two areas wherein as an investor, we can learn a lesson, right? And we want to deep dive into it. And if the time permits, maybe touch upon banking as a service. That's a topic that has been pending for some time, but it all depends on how our discussion goes, what questions you may have, how deep we get into, all this SVB and option trades. So that's what I have in my mind. And of course, we'll talk a little bit about the macro side of the house. Okay. Elon interested in buying SVB? I don't know, but as of yesterday, I didn't hear anyone. But I know that, of course, for this whole weekend, parlays, these FDIC will be talking to many companies to see who can buy SVB. They do have to, they're looking for someone to, take ownership of that so that the uninsured depositors can also be made whole. I'm sure they will not get 100% of their deposits, but whatever they can. Elon to make it a digital bank. I don't know if the company may want to sell themselves to Elon. But anyway, I think company has nothing to do They have no say. Now it's under FDIC receivership. What happens to the shareholders? So SVB is a Silicon Valley bank, but it's a part of, I think, Silicon Valley Financial Group, which have some other business also, but eventually shareholders will be wiped out, right? Right. I know on Friday, the shares were halted for trading because it looks like on Thursday it fell down, on Wednesday it fell down 60%, Thursday it fell down another 60%, Thursday after hours it was down about 20%, and then Friday they halted the trading of shares while they figure out what's going to happen, and eventually FDIC took it over, regulators shut down the bank. So shareholders are, like Jay mentioned, they are the last in the line. The depositors are first, shareholders are the end, and I don't think anyone will even think about or care about shareholders. I mean, that's a risk we take. So shareholders will get wiped out. Unless, so, someone buys it and someone has bought, is that some traders are trying to play the distressed asset game. In that case, yeah, but I mean, that's a high risk game. I'm not playing that. But it's been, I would say, after 2008 kind of a crisis, this is the biggest bank crisis that we have seen, right? And the story is unfolding by the hour. So I think this weekend I'll be a little busy. I would want to catch up on what's happening. I did see on LinkedIn, many startup founders are like, what the heck? They are trying to log into their account on SVB, can't log in, and having tough times. So I found this quote very apt for today from Lenin, is there are decades when nothing happens, and then there are weeks where decades happen. And this week was exactly the week where decades have happened, because we saw the second biggest bank failure in US history. And actually there were two bank failures, but the second one, now no one talks about so there is a bank which voluntarily closed its operations during earlier part of the week, right? And someone had talked about this and asked my opinion on Silvergate Capital, right? Last week. I'm like, I'm not playing that Silvergate Capital, because I think they were completely distressed. And early this week, they voluntarily wound down their operation. They closed it, right? But come Wednesday, Thursday, no one was talking about it, Silvergate, but everyone was focused on what's happening to SVB.
Vivek, I have a question. What happens to in the money options when a company is shut down? For example, let's say Silicon Valley. Somebody bought, it's hypothetically put options, right? And they're in the money, they're looking great. But then the stock gets shut down and it never gets to that expiration, let's say next week, right? And they bought the 100 or whatever put, and they're looking great because it was trading at 39. Mm-hmm. But now it's shut down, taken off the market. Do they ever get to recover that in the money portion?
So I think you should look at OCC
settlement.
Yeah. They will issue a note in terms of what happens to those options.
Okay, because I could see it safe, like selling a call. You have the money in hand, and even if it doesn't settle, there's nothing to take from you, right? Because you take the money up front. But when buying a put, you have to wait.
Yeah, you have to wait for it. Yeah,
to get paid.
Correct. So I'm not exactly sure what's going to happen. I mean, I'll have to go. I know that I had some options on RSX, and then after the Russia invaded Ukraine, the shares were halted, but I never had gone back and said, what happened to that? I mean, it was a small amount, so it really didn't bother. But I mean, whatever the treatment is, OCC, you can probably check it on the OCC website. They will have a circular out on what's there for those, how the options, what's the treatment for the options on SVB. And again, this it's not that the trading was halted, but I think the stock ticker is still there. It's not that they've liquidated and that's gone out, because as Silicon Valley Bank, as I was mentioning, it's a part of a Silicon Valley financial group, though it's the biggest part of that overall financial group. So I think that probably trading will still resume for SVIB. I think that's the ticker, and those who had bought put options probably will will make money. Again, yeah, if the shares are delisted or stop trading at all, then OCC will issue a circular. But I think probably this is like they halted the trading for Friday.
So there's a second ticker, because I'm not finding that SVIB you mentioned about Silicon Valley.
Or it is SIVB, because I think in one of the cases I put the ticker SVB, and which is, oh, that's not the ticker. SIVB.
Oh yes, SVB Financial Group. Yeah.
Yeah. So this is the so
it rolls into them.
Yes.
Mm-hmm.
But this is the biggest. The Silicon Valley Bank is the biggest business. That's what my understanding.
Yeah.
Okay. All right. I see another comment. What bank or security is safe for parking cash? We will talk about it. By the way, Silicon Valley Bank didn't hold up because they did anything risky, right? And I'm running ahead of the session, but so let's talk about that. What happened? Because this is what perplexes many investors. Because first when I just shared this in one of my friends' WhatsApp, they say, what risky loans did they make? I'm like, nothing, right? It's not that they did anything risky. And that's where some nuances that we have to understand as an investor, even as a retail investor, for our own managing our own money. Okay. And I know a few of you are in that WhatsApp group where the question was asked on, I think, Thursday morning. And then when I responded, and by Thursday evening, we had a prime example of Silicon Valley Bank, right? I'm like, gosh, what a coincidence. I just explained the risk, and in the morning and then the evening, we saw that risk became reality and it closed down the Silicon Valley Bank. But I explained it from a perspective of a retail investor, but even corporates are not immune to that. So that's a learning I want to, now talk in a larger group, is, hey, what happened here? So they collapsed, they lost like 60%, 80%. But if you look at their balance sheet, right? Balance sheet is solid. Their liabilities, total liabilities, these are the customer deposits. Customer deposits means if you are because this company actually dealt mostly with the Valley startup companies. Of course, there are other bigger companies who also have accounts with Silicon Valley Bank, but majority and the biggest customers, or the most customers, were the startup firms. So they have their deposit $173 billion, plus they have taken some other debt, right? So the customer's deposit is actually a liability for the bank, because they have to, for us, our cash is an asset for us, but when we give it to bank, it's a liability for bank, because bank is supposed to hold on your behalf and should return you when you ask for it. Right? And this, on right side, you see the assets, right? Loans that they made, the maturities, securities that they bought, cash, and something else. So overall, their balance sheet is strong. They have $195 billion worth of liabilities. They have $208 billion worth of assets. So there is nothing wrong from a balance sheet perspective if you look at the numbers. Right? And now if you look into what kind of securities they hold, that's also pretty good one, right? They are not putting money in any crappy, crappy corporate bonds, etc. So 62% is in cash and fixed income. out of the fixed income portfolio, 92% is in US treasuries and the securities that are issued by government enterprises. Right? Now, these are the ones which we call as the safest instrument, one of the safest instrument in the world, right? When there is a crisis, everyone in the world runs towards buying US treasuries, US bonds, US notes. Okay? And Silicon Valley Bank also had most of their portfolio of assets in the US treasuries and mortgage-backed securities, which are very safe. It's not that we are right now, we are having a mortgage crisis, that there is a, they could actually, those mortgage bonds were under distress. We are not in 2008 situation where people were not paying their mortgage. Right? And US Treasury is one of the safest instruments in the world. And these slides are from their Q4 deck, which they presented in mid of Jan. Right? So situation changes in a few weeks. Right? They have been getting, client funds have been growing. This is the like $173 billion what I mentioned. Right? So during COVID, a lot of companies, you got a PPP loans, a lot of VCs raised tons of money. And then the VCs, a lot of VCs also park their money with the Silicon Valley Bank. And then the VC funded startups also use Silicon Valley Bank. So you see that during the COVID, they saw a huge jump in customer deposits, right? From 192 billion to overall 329 billion. So if we just look at this high level, they got a good balance sheet, right? They have like $13 billion more assets than the total liabilities. The assets that they hold are one of the highest quality assets that you can find, which is US Treasuries and the securities issued by the US Treasury, by the government agencies, right? Mortgage-backed securities from your Fannie Mae and Freddie Mac, right? More than 90% of the assets were there. So this is what's so surprising is what the heck happened? What happened in 24 hours that the bank just folded? Right? And now, and I'll explain it. The biggest irony is they went down because they were holding treasury bonds and mortgage-backed securities on their balance sheets. Right? There were no option stuff. There were no, in 2008, we saw Lehman and all other banks engaging into a lot of derivative trades and, creating a different tranche of different financial instruments. There was nothing of that sort in case of Silicon Valley Bank. No derivatives, no crypto bets, plain simple treasuries and government issued securities. And that's the irony of, right in front of this collapse is it went down even while they were holding the most, I would say, the safest asset in the world. Isn't that perplexing? Because first thing you'll ask for, maybe they lent it to a very, maybe their lenders are not giving them money back. That's not the case. They do have some lending portfolio, but that's not distressed asset. So now let's figure out what happens and what's the lesson that we can learn as a retail investor, because right now T-bills are paying, decent amount. I think I talked. No, my next ladder of T-bill was executed on Monday, and I got 5% in this ladder, which I'm building a ladder for 17 weeks, right? So T-bills are very attractive. Treasuries are attractive. We are seeing a lot of retail investors also getting good treasury, including me. It's the first time in my life that I've actually bought treasuries. Right? I've been doing it for now 6 months, ever since we talked about building a treasury ladder. So if those are the, most secure, then what happened with the Silicon Valley Bank? So, and this is a screenshot I borrowed from that WhatsApp chat, wherein one of our friends was interested in buying a treasury. They went to the brokerage or other firm that they have an account with. And there was a question asked, which says, treasuries are one of the safest instruments. Then on the right side, they also see may lose value, not FDIC insured, no bank guarantee, may lose value. So how can the safest instrument in the world actually lose value? How come Silicon Valley Bank, that held billions and billions and tens of billions of dollars in treasuries and mortgage-backed security, blew up? Let's dig deeper into that, and that is what should help us. Say, and again, I don't know what the overall duration of Silicon Valley Bank is, but just an example that will help you to understand is, if you are buying a treasuries, and I, at the risk of repeating ad nauseum, I'm going to say it once again. If you are buying a treasuries or any kind of a bonds, not just treasuries, any kind of a bonds, make sure that you can hold the bond till maturity. I mean, I'm not going to get into very sophisticated, I'm not a bond trader as such. I'm saying as a retail investor, right? We don't have a time to look into and do specific bond trades. If you're a bond trader for a Wall Street firm, go knock yourself off for how you want to deal with bonds and buy and sell every day. But if you're a retail investor like me, if I want to hold any bond or treasury, I want to make sure that I have enough wherewithal to hold it till maturity. So the ladder that got executed on Monday, in which I'm getting APY for 5%, I will get those 5% at the end of the maturity. What happens in between is anybody's guess, right? So if you are buying any of these fixed income instruments, bonds, or T-bills or notes, make sure you can hold it till maturity. If you have a need to sell it before maturity, you may actually incur loss. And that's exactly what happened with Silicon Valley Bank. Even they are holding these treasuries, they're holding mortgage-backed securities. The securities and the bills that bonds they're holding are long durations. And now they need the cash today. And they had to sell those today, and they incurred losses in that sale. And that's what, is perplexed everyone. How can treasury lose value? Yes, it can lose value depending on how the interest rate environment has changed. So here's the mathematical proof of it. So you bought a bond, 10-year bond with a 2% yield. Right? So these bonds on the notes, etc., are sold at discount. The way it works is you will actually pay $83 right now, and a 10-year, you'll get it at let's say you bought it in October 18, 2022. You invest $83 right now, and in 2032, after 10 years, you'll get $100 back. Right? So that means it's around 2.05%. Okay. So this is what, let's say, Silicon Valley Bank did, because if you go back, they had tons of customer deposits coming in 2020 and 2021. Now, these customer deposits, go further up, comes onto the liability side. So now they have to deploy these funds, and so that they can also increase their asset side of the house. So how you deploy the funds? You can give a loans to others, or you can buy an assets, right? What Silicon Valley Bank did, they bought long-term assets, they bought long-term treasury bonds and long-term mortgage-backed securities. Right? All right, fair enough. Decent trade. Yeah, and whatever the duration is, right? I want to buy that, and I know that these US government won't fail. So these are the safest instrument. I buy and hold on my balance sheet. So far, so good. No problem. But what if the macroeconomic factor change? Now, what has changed since 2020 and 2022, 23 today? The big macroeconomic factor that has changed is interest rates have increased. Not just small increase, it has increased by a lot. Now, if the interest rate has increased, what happens? The bond prices go down. Why? Because the bond buyers will need to be compensated for it. So, assuming this is Silicon Valley Bank, and again, I don't know if they had a 10-year bonds. I think they probably had all long durations, some maybe 3 years, 7 years, 10 years, right? Let's say they bought it in, instead of 2020, let's say they bought it in 2022 when the rates were 2%, right? Now, the idea was to hold it till maturity. They would have earned their 2%. But 2 years later, they need to sell it because they have a liquidity problem, or they need a cash for whatever business reasons. Now, if you're trying to sell that same bond that you bought at $83, after 2 years, when the interest rate has increased to 5%, you will have to sell it at $71. So 3% change in interest rates actually caused 13% decrease in the value of the bond that you have been holding on your balance sheet. Now, how do I use it as I hope that makes sense. Now, the reason why the value will go down is, now, if I'm a Silicon Valley Bank, I bought it in 2020. I paid $83. Interest rates were 2% at that point of a time. Now, Fed has changed the interest rate. 10-year bonds are now, new 10-year bonds are available at 5%. So now I'm going to the market and saying, guys, I got a 10-year bond available with me. It has got 8 years of value left in it. I bought it 2 years ago. It has got 8 years value left in it. I want to sell this. Now, whoever is the buyer of the bond is, they will look at it. Okay, I buy this bond from you, which has got a rate of 2%, right? And I'll hold it for 8 years. And either I can buy from you. If I, as a buyer, I have a capital deploy, or I can go outside and go buy a 10-year bond from US Treasuries, which is yielding me 5%. So for me as buyer, I want to make sure that I get equivalent 5%, whichever transaction I want to pick. So if I want to buy your bond, I want to make sure that my return is equal to 5% for these 8 years that I'm going to hold. It means I won't be buying it at $83. If you sell me at $71, then the return will be equivalent of 5%. And that is why the bond value decreases if the interest rate goes high. So, and that's exactly what happened with Silicon Valley Bank, because they were holding a lot of these bonds, which were long duration bonds. So this is a duration risk that, it blows my mind. How come, they don't just, these CFOs, etc., are paid millions of dollars, and how could they miss some basic thing that we as a retail investor focus so much on? Is never try to finance your short-term goals with your long-term investments, right? If you got a kid if you need to buy a car in next 6 months, don't try to finance it with the stock market. You got a kid going to college next year, don't you put money in the stock market, to finance that. You need to buy a house in 2 years. Don't put that money in the stock market.
Vivek,
These are short-term needs. Yeah.
what you said, short-term funding for long-term goals, that's what started the East Asian financial crisis. Are you familiar? That's what Thailand and I think Korea did. Are you familiar with it?
I know that in 2000 we had those East Asian crises. Right now I'm a little hazy on the details of it, but
Yeah, they just financed long-term goals with short-term bonds.
yeah, so that's the problem, right? You always have to manage the duration. I mean, WeWork blew up because of the same thing. They got in themselves into long-term commitments of the real estate contracts, and were trying to finance with the short-term rentals that they get from their customers on WeWork, and that's why they've never, it was such a shady business to begin with. So even as a retail investors, we have to take care and of managing this duration. So if you are you're interested in US Treasuries because they're yielding 5%, make sure you can hold it in maturity. So only pick up a duration which are comfortable, saying, okay, you don't have to withdraw it before that maturity date. In some cases you could, but then you have to make sure you run the calculations to see that you don't have to sell it at a loss, right? But I don't want to get into those details right now. I think sophisticated bond investors do that, and you could also, but for me, the basic idea is I buying treasury, I can hold it for 17 weeks. And that's why it is important for me is I'm building a ladder so that I have a liquidity coming in if I need something to cash. So this is what happened with Silicon Valley Bank. Right? So they had a huge run up on deposits. We saw that graph, and they had to put this capital to some use to generate some yield. What they did was they bought it in securities and the mortgage-based securities, treasury bonds, all of them were yielding less than 2%. Right? So if they hold these in their balance sheet, they would have made 2%. So, but what's been happening in the recent times, especially in 2022 and so far in 2023, is a lot of these startups, they don't make money. And right now their businesses are also not doing good. So they've started to withdraw cash from Silicon Valley Bank. VCs haven't been, we haven't seen a lot of VC, raising new funds, because VCs also deposit their money on the Silicon Valley Bank. And even that business has also kind of dwindled over the last few months, right? So third thing is, if either Silicon Valley Bank gives me, if I'm parking my cash in Silicon Valley Bank as a VC, either they give me a competitive interest, or I'm going to take my money out and invest in treasuries. So when these customers of Silicon Valley Bank, VCs, startup companies, they started to withdraw they wanted to withdraw their cash. So SVB started to face a lot more cash redemptions than what they could have anticipated. Now, to shore up that cash, they thought to sell these securities which they held. So they sold $21 billion worth of US securities and bonds, and they took a $1.8 billion of loss when they sold this. And this is an important point, that your treasury bonds bills can go down in value if the interest rates have gone higher, and they will go down in value, right? Based on the simple math, they will go down in value if interest rate has increased. So they took a $1.8 billion of loss. Now, also what they decided that they will also do a secondary offering to raise $2.25 billion from the market. Now that will give them enough cash. Their idea was to let's take this cash and then do the right thing, which is invest in treasuries, but not in long term, but do a short term. Because the deposits that they have, their customers can take away that deposit whenever they want to, right? That's their legal right. So those are like a liabilities which can come due anytime. And you always need to have enough cash available or equivalent cash available to serve that liability. But if you have tied up your cash into assets that are long-term and not maturing at the same rate at which your liabilities are, coming forth, you end up into this problem. So what they decided to recapitalize their balance sheet, sell these long-term bonds, take a loss, and then go and buy short-term bonds, which will mature, at whatever intervals or regular maturity, so that, as and when the redemption requests come, they will be able to service the redemption request. Then to again shore up the balance sheet, they did a new capital raise, 2.25 billion secondary share offering. When they came out with these news, there was nothing wrong in that. But when it comes to the banking, the most important thing for a bank is the trust, or I would say, or idea of a trust that customers put in a bank. The moment they came up with the fact saying, oh, we incurred $1.8 billion of loss, and we're going to do a secondary offering, there was a panic in the VC community. Remember, this is the biggest bank which VCs bank with. So VCs started panicking. They didn't know what to do, what to make out of this secondary offering. And by the way, this $1.8 billion loss is bigger than their whole 2020 profit. So that's completely wiped off their 2020 profit. I think 2022 profit, which was around, I think, $1.5 or $1.6 billion. And now in 2023, you have taken such a big loss. So VCs panicked. They thought, gosh, the bank may go under. And then they started calling up their portfolio companies and told them, take your money out from the bank. And which is what a classical bank run is. Today, let's say, forget about Silicon Valley Bank. They bank, you could come and say, oh, they bank with such a high risk in, the startup companies. That's why they've gone under. Today, if a rumor starts and everyone goes to Wells Fargo and wants to withdraw their fund, maybe Wells Fargo can service up to 25%, customers withdrawing it, 30% of the customers withdrawing it. But most of these banks, all banks work on a fractional reserve basis. The moment you cross that threshold, there will be a run on the bank and Wells Fargo could go under. And these things happen just in a moment. So that's where a bank run started. No one wants to be the last man standing, right? When a bank run happens. So customer withdrew $42 billion of deposit in one day, right? I think the news started coming in around maybe 10, 11 o'clock or something like that. And by the end of Thursday, $42 billion of deposits were out. And by some of the internal calculations of Silicon Valley Bank, they were well capitalized to serve the redemption request for up to 25%. But when at the same time, everyone wants to withdraw their money, that's the classic bank run happened. And then they didn't have that much of a cash available. They still have securities available, to them, which obviously were underwater. So because of the mass hysteria, no one wanted, gosh, I want to take my money out today. So that's the reason. it went under. It was not a solvency issue. It's not that their balance sheet was upside down. It was more of a liquidity issue. On their balance sheet, there are some assets which were, had a longer maturity and were not matching with, their liabilities requirements. Right? But who cares? So once the VC start calling up and say, hey, take your funds out, we don't know. And that triggered the mass exodus of funds from the bank. And then it just went under 24 hours. Right in front of our eyes, 24 hours, the bank went under while holding the most secured assets in the world. That's a lesson. It's a duration mismatch. And so that was mind-boggling for me. How could we just do that? So what's the impact of it now? This has happened. Now hundreds of thousands of startup funds are stuck there, right? If you have up to 250K, FDIC will make you whole by March 13th, which is Monday morning. You'll get your 250K. Anything beyond 250K, they'll have to wait. Who buys it? Whether you'll get dollar for dollar, probably not. You might get 60 cents for a dollar, 40 cents for a dollar. Now that is anybody's guess right now. The biggest worry is many of the startups may not be even able to run the payroll. If all of their money was stuck in Silicon Valley Bank, they may be able to get 250K out, but if that's not enough, what are they going to do with the employees? They can't. Are they going to furlough the employees? Or maybe they have to lay off those employees. You cannot pay the wages if you have the employees have done the work. You run your other problem. So it's gonna be brutal if this is not resolved. And again, this was for 40 years. This was the go-to bank for a lot of these tech companies. It had helped all the innovation in the valley. But it's a dog-eat-dog business. When they were in trouble, VCs didn't think twice before withdrawing all their funds. If it was a systematic withdrawal kind of a stuff, right? Hey, don't panic. Companies do secondary offering multiple times. The share goes down. That's fine. It's a shareholder problem. Their assets in the balance sheet is still okay, right? We have seen many companies do these secondary offerings, right? Share goes down. That's fine. If, let's say, all the VCs or the customer would have worked together, bank would have been fine. Because they would have raised these funds. Shareholders could have got wiped out, which anyway they are wiped out now. But the depositors, the startup companies whose funds are there, they would have been okay. But now we are facing a scenario wherein they won't even have money to run the payrolls. Not just small startups. I think even some of the big companies like Roku, Roblox, they also have their funds stuck at Silicon Valley Bank. I think Roku, and again, some of these publicly listed companies had to do SEC filing. I know Roku mentioned that 26% of their cash or cash equivalent was at Silicon Valley Bank, some $600 million. I think Lemonade is another one. Roblox is another one. Probably there are some more companies who have their cash stuck at Silicon Valley Bank. But this is I would say the blizzard or the storm that has gone through Valley on Thursday/Friday. So let's keep our fingers crossed. And I think heart goes out to those CEOs or the startup founders that you raise so much money and now that we don't even know when they will see, when they hope to get their money back. And whether they'll get the full money or not, even that's questionable because FDIC covers only 250K. Anything beyond that, they may never see it. You're a startup, you raised $10 million, you kept it in SVB. You may not see it soon. I think eventually, once these mature and I don't know what the details going to be, but right now it's a tough situation. Right now, the VCs are crying for help, which I find it disgusting because guys, this is you who have done this. Founders Fund from Peter Thiel came out on Thursday saying withdraw funds. Y Combinator came out and told its portfolio companies, limit your SVB exposure, essentially saying withdraw your funds from SVB. And now the Y Combinator CEO is all over Twitter saying, oh, government should help us. Thousands of the companies won't be able to run payroll. I find it, really disgusting that they're talking from both sides of their mouth. And I know why they are saying this. I'm not sure how much, it is because now their dollars are stuck. Even VCs could have parked, and I'm sure they would have parked the money in Silicon Valley Bank while they are looking to deploy it for a startup. So their LP's money is now stuck at Silicon Valley Bank. Now I see a bunch of VCs, famous Valley VCs coming and talking about this is very serious. We need a government has to backstop it, right? Hundreds of startups are going to miss payroll if it doesn't find a buyer this weekend, or if a government doesn't backstop it. And Jason Calacanis, he's a famous Uber investor. This is very serious. If taxpayer backstop SVB, they should be senior and make back at least 3x investments for doing so. Why? Why taxpayer should now, start to come to rescue? And now David Sachs, another one. Where is Powell? Where is Yellen? Stop this crisis now. Announce all the depositors will be safe. I know because a lot of his money will be there as well. Right? Gary Tan, who is the CEO of Y Combinator, right? The same Y Combinator, or of the same, birds of the same flock, which asked their companies to withdraw their funds, which caused this problem of a bank run, is now saying 30% companies exposed can't make a payroll. If you're not, if you or your company are affected, I recommend you reach out to your local congressman to get this on the radar today. Make whatever you want to make out of it. I find it really, double speak from their perspective. Probably a lot of these VCs' personal money is also in this, because and again, the way ecosystem works is you're a founder, you start a company, you build your relationship with SVB, then SVB also does a white glove service to these founders. These founders become CEOs, they move over to become VCs and all that stuff, and they continue their relationship with the SVB. They have their mortgages, they have their deposits. So no wonder I see a lot of these VCs now coming and crying for, we need, government help to help us out here. It's a question of startup. I understand, of course, there are startups and we should have those, but I think a big chunk is also, there's ulterior motive. Their funds are stuck as well. The funds that they have not even deployed to startups are stuck as well. I think that's where the bigger issue may be, because remember in 2021 and even in 2022, these VCs had raised tons of funds, but have not deployed it, right? That's why many times we see a lot of dry powder sitting on the VCs. Now that dry powder is stuck. So I guess that's the case. But we had another bank, California bank. Gosh, bad week for the banks to be in California. That folded. That was a crypto bank, Silvergate. And everyone blamed crypto, VCs, media, and critics. They are saying, oh, we should separate out crypto from bank and all that. We should regulate banks more, not for, allow them not to deal with crypto. But SVB wasn't dealing with crypto. Their exposure to crypto was not there. I mean, probably, but very small. Silvergate was fully crypto. What can you do? The regulations cannot prevent when bank executives are in, they want to commit harakiri. I would say that's what happened. Same was the case with Silvergate. They actually had to sell their bond portfolio at a loss. But they were still able to make all the depositors whole because, given in the crypto space, you don't do the whole fractional reserve banking, reserve banking, etc. Cryptos are a little more cautious from that front. So you can blame that, taking crypto risk and all that, but at least they didn't have to tap into FDIC insurance fund to give money back to their depositors. Shareholders get wiped out. That's the case in both of them. But now in a Silicon Valley bank, which is fully regulated, normal bank, working as 16th or 15th largest bank, now they're looking for FDIC to help them out. So that's a story of Silicon Valley Bank. And the irony is how the bank got bust while holding the safest assets on its balance sheet. And the lesson for us is duration mismatch. That's those two words, I think, tells the whole story. All right. Wow. Oh, we are 10:54. It took longer than what I thought, but I hope this gives you insight on when you're looking to add treasuries into your portfolio, what's the stuff that you should be worried about. Okay. All right. I'll skip the macro and jump onto the second topic, which is of another learning of how a seemingly, this was a question from our last week, how a seemingly zero risk trade actually can blow up your accounts. Before that, any questions on SVB? Oh, those who joined a little late, today we're gonna only have a 1 hour session because I have to go out. So we'll be there only for, let's say, max 10 minutes. Okay. All right, so if no questions, last week someone asked, are there zero risk option trades, right? So at that time I mentioned, I had one instance where I was actually able to put a zero risk trade, which was this. This was actual trade that I had done, having an iron fly, $20 wide iron fly. Are you able to see the details? Okay, let me. It's an iron butterfly with a $20 wing, and I sold it at $20 premium. Right? And there was a guaranteed no loss trade. But you can't lose money. Stock goes to 110. It's okay. Stock goes to 20. It's okay. If it stays between these break-evens, I tend to make what, 10K or in between 0 to almost 10K. So where's the catch? And then I covered it in session number 12. Today we are 165 session. But this is what I covered in session number 12. So let's listen to that. I don't have to say that again because I already covered it. But if you have questions, can ask me. Before that, let me know if the audio is unclear. Next one, Nikola Motors. And the reason I brought up Nikola Motors and want to talk about, was the audio okay? That's my recorded. I mean, we do have this video on the website. Was the audio okay? Okay, so I'll give rest to my vocal cords. Now you can listen what I said. Almost, it was what, June of 2020. It was the 12th session in which I had covered this. Here you go. Here is because there was a lot of chatter on the Slack channel about Nikola. What can we do about it? The stock looks very promising, especially the option trades. There were instances, and I think there probably are still instances wherein you can put an option trade which seemingly looks a zero risk trade. I mean, I talked about it when I put on this trade. I'm like, it's a speculative, looks like zero rates, so I need to study more to figure out what's happening with this. And I only did very small contracts because I'm a firm believer that there is no free lunch. If it looks like a zero risk, it means I'm definitely missing out something. And so, by the way, even after like almost 3 years, I still believe that there is no zero risk trade. If you are finding a zero risk trade, it means you haven't studied, you haven't done enough study to figure out where the risk is. Okay, let's continue. So, and I know some of my friends, some of the folks I exchange my thoughts with, some of them have lost money in that. And the seemingly zero risk trade, if people have gone way big on their positions, they have lost a lot of money. I want to talk about that a little bit. Also, to drive home a point that we've been talking about almost every time is one thing, only one thing if you want to carry from any of option education is position size. You can go wrong on everything else, but if your trade is sized for your account, you will still survive to live another day. And this lesson was again a lot more evident, with a lot more became a lot more important, especially with Nikola, because the trades seemed to be risk-free, zero risk. And I know of some of the folks who piled up onto it and then lost money. So let's look at that. And if you have any questions on Nikola Motors trade and what's happening with their stock, and how could that be, those trades be feasible, I'll be happy to address. But let's look at some of the trades, right? So for example, this one, and do let me know if you're able to see this clearly visible, this graph. Okay, so if you really look at this graph, this was the trade that done, and this is a graph of an iron fly, means we got a short strike at 65. Okay, I'll skip this. I think I already explained this today. So this it's $20. Stock cannot be an actual trade. Whatever, if in this case I'm looking at $65, I'll get $6,500 in my account for his whatever. If in this case I'm looking at $65, I'll get $6,500 in my account, but I will be short of stock. Means my broker either has to borrow that stock for me, or I have to borrow or buy the stock at whatever cost it is right now. So now comes the crux why this was really a challenging one, because there were no stocks available for brokers to borrow. Okay, so the risk in this trade was, even though you could get $20 for a $20 wide iron fly, the major risk was risk of early assignment. So going back to the trade, yeah, this was a trade that I placed in 2020 and I talked about it in 2020. Going back to this, I had sold a call and a put at 65. if let's say the stock moves to 70, 90 or 100, I could get, this stock will be assigned to me at 65. This graph represents how it will be at maturity, right? But I could get assigned before maturity, and that's where the risk was. The risk was not in the premium is less or anything. The risk was in an early assignment. And this stock was so hard to borrow at that point of time because it was a meme stock. The brokers were not willing to hold that. Remember, if I'm assigned if the call get assigned to me, I'll receive the dollars in my account and I have a short stock position. Because I have a short stock position, broker will have to borrow the stock from somewhere. They'll have to find the stock from somewhere. Nikola was, sorry, I'm rushing because I have to now go. My daughter already pinged me. So Nikola was very hard to borrow stock. The amount of, whatever the margin fee that they pay was up to 400% on borrowing of a stock. So brokerages were not willing to carry the short stock position overnight. So if you get assigned a stock, brokerage will want you to cover your position ASAP. So that's a problem that happened. The borrowing cost for Nikola stocks was as big as almost 400%. And I think some weeks it was almost 600%. So brokers really did not want to get into a position wherein that their customers get assigned early. And if their customers do not have a big enough account size, big enough money in their account to manage the positions, they were just calling, their customers saying, close that position right away. So this is one person who had 100 contracts. Amazing. I won't say that the trade was, that it was a trade that killed him. It was the 100 contracts that killed him. That was too big a position size for his account balance, right? I think this trader has $25,000 account and he took 100 contracts. Really, really too big, even if it seemingly looks like a risk-free trade. Another one had a 42K account. And they say, hey, they called me too, took a huge loss. They liquidated my 42K account. And we asked, how many contracts do you have? Yeah, 220 contracts. So again, the point that I want to help and bring home here is, if things look too good to be true, it probably is. There is no free lunch. The pricing is, most of the time, is perfect. So don't go overboard, irrespective of however confident you may be in your trade, however guaranteed profits you may, it may look like to you. Don't ever violate your position size rule. All right. So coming back to this, I think I still hold the two. Position size is the most important. I, in fact, ended up making money in this because, yeah, the stock was high. My account was big enough. Or let me put it the other way. My position size was small enough because I didn't understand where the risk is. So I did only 2 contracts, right? I didn't do 200 of them. And I ended up making money on the same trade in which some of my other friends actually lost their shirt. So it's not that the trade was bad. It's the position sizing is wrong. It is that you never understood where the risk was. I did not understand where the risk was. That's why I did only 2 contracts. And when I figure out, okay, where the risk is, then, then you position sizes accordingly. All right, so was a second learning from today, how something which is seemingly zero risk trade could actually end up blowing accounts. How something seemingly which is the safest instrument in the world could actually blow up the whole bank. Right? So I leave you with those 2 thoughts. Thanks everyone for joining me today. Like I said, today is going to be a short session and I need to rush out, but I appreciate you coming in here and, going through this. Next week, we'll have a full 2-hour session. Thanks everyone. Goodbye. Someone asked for the link, so I did paste that link in the chat. So you can take it from there. All right. Bye-bye.